I'm Emily Chang in San Francisco, and this is Bloomberg Technology. Coming up in the next hour, Bloomberg broke the story. The first time WeWork tried to go public, that was before the implosion. Since then, the company has regrouped, reorganized, and is now planning on a SPAC for its public debut. We've got all the details. Plus, speaking of going public, shares of the online consignment shop thredup popping in its debut. I'll speak to CEO James Reinhart about the demand for sustainable fashion and the future of the resale economy. And all eyes on Alabama. Roughly 5,800 Amazon workers in Bessemer enter the final days of an election that will decide whether or not they unionize, the potential outcomes, and what happens next. All those stories in a moment, but first, risk appetite back on. The S&P 500 posting its best gain in 3 weeks. Bloomberg's Kriti Gupta and Ed Ludlow have more on the markets and movers. Kriti, we'll start with you.
Well, Emily, you did see a lot of green on the screen today, and we have to really think about this because high-flying tech here was not high-flying today, actually flying a little low, underperforming the benchmarks. You can really see here the S&P 500 in the green, the NASDAQ 100 outperforming. Big tech, not so much. Your Apples, your Microsofts, your Teslas, not doing those massive gains. What's interesting, though, is that this is actually still doing better than what you're seeing globally. We used to be at a point where globally tech would rally, and now it seems like a regional story. You can see at the bottom, this is the NASDAQ Golden Dragon Index, housing those Chinese ADRs. You can see that in the red, not doing very well, even compared to the NASDAQ 100, which is up 1.6%. And of course, this is all coming with the background of those climbing yields, except for this week, when you actually saw yields decline for the first time since January. If we flip up the boards, I can actually show you a picture of that. And this is, yep, here we are. So you can see these like increasing yields, but this week, kind of a horizontal line. Nothing too exciting happening in yields, but that's very good news for tech because it means they're less subject to the volatility. Flip up the boards again, and I want to show you how this really impacts on kind of a charted basis. Of course, we have this on a massive time scale. You can see that massive volatility spike in the middle, and then towards the end, the blue line is going to be that NASDAQ 100 volatility. You can see it edging lower with the S&P 500's volatility. Where all the action seems to be, it's in small caps, not in tech, and that's actually a very good sign for those investors who are saying, well, maybe tech has been sold off good enough. We need to just maybe hop back in. So that's the macro picture, Emily. For the micro picture, I want to go to Ed Ludlow.
Yeah, one area we did see outperformance was in the chip sector, semiconductors, but I want to narrow it down even further to the companies that make the machines, that build semiconductors, that fabricate semiconductors. Applied Materials, one of the best performers on the S&P 500 today, up almost 7.5%. And you can see that Lam Research, another company that makes those machines that fabricate semiconductors, up 6.6%, helping to lead the stocks higher, up almost 5%. Flip up the board, though, and you can see this is not just a one-day story. Since the start of the year, there's been real outperformance, not that one, but there's been real outperformance of the companies which manufacture the machines, which manufacture the chips. Why? We know, Emily, because of all the investment that's going into building new semiconductor factories. In particular, Intel in the last 5 days committing $20 billion, the likes of TSMC also eyeing new factory, new capacity. No wonder investors are putting money where those companies are going to be supplying those factories with new machines. Also looking at SPACs, I know you're going to talk about this in great deal, but welcome back to the party, WeWork. What a blast from the past. If we flip up the boards and take a look at WeWork, the SPAC that has acquired it in a reverse merger to take the company public, absolutely popping on Friday, up more than 20%, Boex Acquisition Corp. And if we flip up the boards again, what's really interesting, when a SPAC or a special purpose acquisition company IPOs, it tends to do so at $10 per share and then stay pretty dormant up until the time that you start to see rumors, you start to see reports that it will find a target and take them public. That's the target. That's where we got the report and confirmation that WeWork is going to go public via reverse merger and that massive pop that you saw. And I can't wait to hear about this story. What a roller coaster, Emily.
All right, Ed, WeWork back with a SPAC. We're going to talk about it right now. Thank you. WeWork agreeing to a blank check company deal that would take the shared office provider public. The merger with the Boex Acquisition Corporation would value WeWork at $9 billion, including debt. Back in 2019, of course, WeWork was valued at $47 billion in a round of financing with SoftBank. Big haircut there. For more, I want to bring in Bloomberg Tech's Ellen Hewitt, who's been covering WeWork very in depth for the last several years. So what's different now, Ellen?
What's different is they finally seem to have a different way to try to go public. This is something that I know they've been working on for a while. And, by the time this deal goes through, it seems like the company will actually maybe go public in the third quarter, which would bring it to at least 2 years since they first attempted it. So it's really WeWork trying to position themselves as like a different company than they were under Adam Neumann's tenure, and trying to say there's a lot of future for this company, especially in a post-pandemic world in which people want more flexibility in their office space.
So before the pandemic, WeWork imploded. There were the cultural issues, the lawsuits, the massive cut in the valuation. Then comes a pandemic and people aren't going to work. How has the company actually evolved through the last year?
Well, they have they've gotten rid of a lot of their leases. They cut thousands of workers. They got rid of all these side businesses that Adam Neumann and his wife, Rebecca Neumann, had started. You might remember WeGrow, the elementary school, WeLive, which they still, I think, technically have. But, they've been trying to cut down on everything outside of the core business and really try to retrench and restart the company. And so, they had a really terrible 2019, and then were hit in the face with the pandemic. It hasn't been easy. They lost something like $3.7 billion in 2020. A lot of that is a reflection of the fact that people just didn't want to go to the office. And even though they do offer things that I think will be helpful for companies in the future, such as more hospitality style type real estate and more flexible office space, the reality is 2020 was an incredibly hard year for all sorts of commercial real estate as well as other real estate companies. And so that has been hard for them as well.
Still, $9 billion is a decent sized company. It's not $47 billion. What's left? How many office spaces do they have? How vast is it? How global is it?
They're still global. It's funny. People, ever since the 2019 implosion, people have they will occasionally ask me like, oh, WeWork's still in business? It definitely is. They have offices all over the world, hundreds of locations, and they're still providing office space for lots of people who may or may not want to go into the office. And their pitch is for the future, if you're head of real estate for a large company, maybe you're just thinking, we don't need that much space anymore. Some people are going to want to work from home. Some people are going to want a hybrid model. Maybe we want our office to look different, to look a little bit more like a hotel lobby rather than individual desk space. There are some companies that are switching toward having basically no dedicated desks and rather like a more flexible space. So it seems like the sort of thing that WeWork can position itself to try to take advantage of. They're still definitely, alive and kicking. And I think this SPAC is their hope to try to get some momentum toward the future.
All right. Well, we'll be watching out for your reporting on this. Bloomberg Tech's Ellen Hewitt, thanks so much for that update. Coming up, CEOs from Facebook, Twitter, Alphabet, all appearing remotely on Capitol Hill. We're getting the rundown from a former head of public policy at Google, Adam Kovacs, and his take on what future regulation we might see. That's next. This is Bloomberg.
If I were those three CEOs, I think all of them experienced something that they hadn't experienced in some of their previous appearances before our committee, and that was a united Democratic and Republican committee.
A lot of members have had separate conversations with these entities from time to time. And as you can see, we were pretty bipartisan in our upsetness with all three companies.
I think the public is finally starting to understand, too, that when a company doesn't make a product, you're the product. Or more specifically, your data is the product. And these companies are monetizing people's data without their knowledge and permission.
Well, I think they should take some responsibility. I know that they may not know everything, but, they're making money off of, tweets and Google and Facebook. So I think they should take some responsibility with what goes on their sites, just like we hold other people responsible.
If they can't police themselves, it's way past time for Congress to take steps to do that. I mean, when Facebook got fined $5 billion, their stock went up that day. These fines don't mean anything to these companies. We feel, many of us, that we need a new federal agency that exclusively regulates these internet platforms.
They obviously have not done a great job on regulating themselves, and so we're going to have to put something, in motion.
Parts of my exclusive conversations there with Representatives Robin Kelly and Mike Doyle. Doyle, of course, the chair of the committee who opened yesterday's hearing. I want to bring in Adam Kovacs for reaction, who previously led Google's U.S. public policy campaigns on privacy, security, antitrust, and more. Adam, we've covered several of these hearings now, and what I would say was different about yesterday is you saw Democrats and Republicans more united, and they also understood what they were talking about. They asked pretty smart, pretty tough questions. What was your takeaway?
I think there are some big questions before Congress, like what's the future of some of our most important technology laws? And the one I'm thinking of in particular is Section 230 of the Communications Decency Act, which is one of the foundational laws for the internet. I do think the representative, right, they were unified in their upsetness, but for different reasons. The Republicans blasted the platforms for removing allegedly too much conservative speech. The Democrats blasted them for not removing enough speech, particularly hate speech and disinformation. So it kind of laid bare the partisan differences about political speech. But I think Congress actually has theatrical hearings like this when there's less consensus about legislating. So I do think these things are inversely proportional to each other. More hearings sometimes means less legislating.
So you were the 7th employee at Google's Washington office. You worked there for more than a decade. Who do you think is to blame?
I don't think there's anyone to blame. I think the fact is, like, you take the question of online speech, and these are global platforms. They start off from a perspective, I think, of wanting to allow as much speech as possible, but they also want to promote trust. They don't want to be a haven for QAnon, conspiracy theories of lies related to the elections or vaccines. And so they're asserting their own First Amendment right to remove that kind of speech. And obviously that's going to be controversial because not everybody agrees with that. But the thing that I love about the open internet is that if you want to see conspiracy theories, you can go to Gab, Parler, 4chan, the open internet, and that makes all those things possible. But that doesn't mean that Facebook and Twitter and YouTube have an obligation to host that kind of thing. And I think that's a really important principle that was overlooked. Facebook, Google, Twitter, they have just as much First Amendment rights as the New York Times and Breitbart.
Well, and if you look at Facebook, Google, and Twitter, you don't have to look very far to find the conspiracy theories that you're talking about. I mean, you have to admit they're not doing a good enough job of policing this stuff. If they don't want it on there, then why don't they work harder to change that? Yeah.
Well, I think what you see is, look, members of Congress have constructive feedback about what they want the platforms to do more of in terms of removing incendiary speech. And some of that feedback can be helpful. The thing that I worry about is when they take that and say, well, let's revoke Section 230 of the Communications Decency Act, which they think is a way to constrain the power of big tech. But the reality is actually, if revoking would probably hurt the smaller platforms. Section 230 is kind of like if I rent a car from Hertz and I run a red light, get caught in a red light camera, guess who pays that ticket? It's not Hertz, it's me. And that makes sense because it promotes my individual responsibility, taking responsibility for my speech. So same thing, if I go into Reddit and I say, John Doe is a crook, John Doe can sue me for defamation, but he can't sue Reddit because Reddit's not expected to review all that. I think that's a really important principle. Revoking Section 230, look, Google, Facebook, Twitter, these companies have armies of lawyers and content specialists. They'd be fine if 230 went away. The company that gets hurt is the next Facebook, the next Google, and all those small platforms that depend on the same liability protections.
So do you think Section 230 should be changed at all? Mark Zuckerberg is arguing for some changes. It sounded like Sundar Pichai is cautioning against any change at all for the reasons that you just mentioned.
Yeah, I think it's widely misunderstood. And again, I keep analogizing to this rental car example. We want people to take individual responsibility for their speech online. That's what helps create a healthier internet. And Section 230 is actually a routing mechanism. It says that if I defame you, you come after me, not the platform. And that makes sense. There is accountability. But if we didn't have that principle, we would really threaten a whole host of smaller sites, user-generated content sites, ordinary websites that aren't in a position to review every piece of comment or content before it's posted. So this is a really important principle that also promotes a diversity of thought and dialogue online. And I think it's just widely misunderstood. I think it's a great law, and I think policymakers who care about healthy online communities should absolutely support Section 230.
Interesting. Now, having worked at Google as long as you did, do you put Google in the same boat as Facebook and Twitter? Obviously, they all have their own problems, and we saw Mark Zuckerberg get the lion's share of the questioning yesterday. But should Sundar Pichai be in the room with Mark Zuckerberg and Jack Dorsey at all?
Look, I love all these companies. I use all their services. I'm a fan of all this. And I think one of the things is, like, companies, they screw up sometimes, right? They have blind spots. Sometimes their products get abused, and that's okay. But I genuinely believe the people who are working at the companies want to do the best thing for society. They want to do the right thing. Sometimes, again, this feedback that they get from policymakers about their speech policies can actually be helpful. It can illuminate some of their blind spots sometimes. But that doesn't mean we should then try to do something that honestly violates the First Amendment, where you would have Congress saying, no website, you can't moderate content, you can't allow this kind of content, or you should allow that. That's a pretty direct violation of the First Amendment. That's not good for Facebook, for Twitter, or for any website for that matter.
Do you think wanting to do the right thing, though, is enough? I mean, it's been over 2 decades for Google, going on 2 decades for Facebook. Congresswoman Kelly there also told us she thinks that Mark Zuckerberg and Jack Dorsey aren't the right people to be deciding how hate gets moderated on their platforms. They're white men. They don't understand how some of this stuff disproportionately impacts minority groups.
Well, that's what I'm saying. I think that feedback like that is really helpful because, again, they do have blind spots. And so I think that's great feedback for them to hear. I do think the thing that people sometimes miss is that I don't think these CEOs really want to be making all these tough speech decisions. It's just a consequence of our age. But I think what they do want is they want to make sure that their services are as popular as possible, or as positive experience as possible. And every decision they make on one of these speech decisions helps shape and reflect what kind of service they want to be for their users. That's okay for them to make that decision, just like Gab and Parler can say, look, we're going to allow anything, and that's the kind of service we want to be for our users. So they're just trying different approaches to this really thorny question of content moderation, allow more, allow less, et cetera.
All right. Adam Kovacs, appreciate your perspective. Obviously, you've lived through it. Thanks so much for taking the time to join us. All right, coming up, we're going to talk about Disney, Netflix, big changes they're making with price hikes. Your all-access streaming bundle might cost as much as traditional cable. We'll break it down. And as we head to break, let's take a look at the markets. Big tech mix today. You're looking at shares of Facebook there, up a bit on the back of that hearing yesterday. Also, Netflix, Amazon, and Apple. This is Bloomberg. It's getting more expensive these days to cut the cord. All those financial incentives you had for dropping cable TV, for streaming services are disappearing, and fast. If you subscribe to the flagship streaming services like Amazon, Netflix, Disney, recent price hikes could bring you to $92 a month, which is almost as much as a typical cable TV subscription anyway. Not that people are likely to go back to cable, but they may look for cheaper options like ad-supported services instead. For more, I want to bring in Bloomberg's Chris Palmieri. So Chris, talk to us about the reasoning behind these price hikes at Netflix and Disney Plus, which is, to be fair, fairly new.
Right. Well, you're just seeing so many. Those two guys have emerged as real leaders here, and they've, so many hundreds of millions now subscribers around the world, and they're sort of feeling a lot more comfortable, and they're raising prices to take advantage of that. So if you get the premier Disney bundle with ad-free Hulu and ESPN Plus, it's now $20 a month just for those three services, which is, a lot of money. And so, and now you're seeing this explosion of other services, just Paramount Plus and Discovery Plus alone this year, and HBO Max and Peacock in the last few months. And so we're seeing both rising prices and more services, and now it's starting to get expensive for the average person to subscribe to all this. So
how is the average person responding? Are they paying up?
They are. You know, a couple of years ago, there was on average, about 2 services per customer. You know, the number we'd always heard when you'd ask in the industry, how many were they going to subscribe to? It was 3. Well, guess what? We're now over 4 and probably no end in sight. You know, there's some services that people subscribe to, and I think they probably don't even think that they're really doing it for video, such as Amazon, or you buy an Apple device and you get Apple TV for free for a year. But they're starting to add up.
So at some point, do you expect consolidation, or are consumers just going to keep paying more? I mean, I'll give you an example. In my house, we still haven't cut the cord, and maybe it's because I work for a television network, but I just haven't been able to get there. And then I'm still paying for all these streaming services on top of it.
Yeah, I think the average person's entertainment budget has gone up. I mean, there's still 85 million people in the U.S. who've got a cable bundle, and most of them also have Netflix and other services. I think we're starting to see, though, the skittishness this week in Wall Street really showed it. A lot of the media stocks taking a big hit because there's a reasoning that there just can't be all of these services and all of them be as successful as Netflix and Disney Plus have been.
Well, and as we come out of the pandemic and production returns, what kind of competition do you expect we're going to see when it comes to original content? I imagine it'll be even more cutthroat.
Well, that's the thing is, which sort of underscores how we're not really going to see people return to the cable bundle, because these companies are all putting their best programs on their streaming services. So you have Disney with Mandalorian and WandaVision, and HBO Max just putting all of their movies this year on HBO, right when they hit theaters as well. So it's tough for people to go back to the old model, and people want to be able to choose what they want to watch when they want to watch it. So that's going to keep growing. The just question is, how much room is it for all these players?
All right, Bloomberg's Chris Palmieri. Chris, thanks so much for keeping us up to date. At least we'll have lots to watch tonight. Thank you. Coming up, thousands of Amazon employees in Alabama are on the precipice of a historic vote that will determine whether or not they will unionize. That story is next. And a pop in shares for the online consignment company thredup as it debuts. I'll speak to CEO James Reinhart fresh off his NASDAQ opening. Next, this is Bloomberg. Welcome back to Bloomberg Technology. I'm Emily Chang in San Francisco. Both the A's in FANG getting our attention today are Ed Ludlow, here to tell us why. Ed, Apple and Amazon, take it away.
Yeah, in the first instance, A is for Apple, up by around 0.5% on Friday. According to sources, Apple is working on a more rugged casing version of its Apple Watch. Emily, I don't know how often you jump in a kayak or hang off the face of a cliff, but according to sources, that's the market that they want to go after. It could come as soon as the end of this year, maybe the beginning of 2022. Flip up the boards, though, because to me, that sounds like Garmin territory, right? That is the kind of niche market that Garmin sells to, those high-end sports watches. This is Apple and Garmin shares over the last 5 years. It was 5 years ago, or 2015, that Apple launched the Apple Watch. You can see it's really outperformed Garmin over that period, but Garmin's not done badly, so that's going to be a really interesting space to watch. It's not the first time that Apple has considered doing kind of a high-end sports-focused watch. Of course, the existing model's pretty popular, based on their health and fitness tracking applications. The other A in FANG is Amazon. So let's flip up the boards and take a look. No sort of hard news on Friday or this week. Up by 0.2%, treading water, right? But there is this key vote on Monday. Alabama unionization. It's something that has kind of been a question for Amazon for a long time now. At the same time, you know, Amazon is a machine. Come with me into my Bloomberg and look at this chart, which shows quarterly net income over the last 5 years. That chart tells the story, right? Look at the last 3 quarters. 2020 was a year where Amazon's profit boomed. No idea what's going to happen on Monday or with unionization more broadly, but Amazon is becoming a profit machine. Flip up the boards again and take a look at this chart, because what's interesting, it's kind of lagged behind so far this year. Shares not just underperforming the NYSE FANG Plus index, that basket with all its big cap tech peers, but also the S&P 500 as well. It was such a blockbuster quarter in the holiday quarter. So what is the next catalyst? Like, what is the story of Amazon? There's one man who really knows. I know you're about to speak to him, Emily.
All right, Ed Ludlow, let's do it. Thanks so much, Ed. It is a critical weekend for thousands of Amazon employees who work at a facility in Bessemer, Alabama. On Monday, their votes on whether to unionize are due, and at issue, wages and benefits. President Biden jumped into the fray, backing the union vote in a tweeted message on March 1st.
So let me be really clear. It's not up to me to decide whether anyone should join a union. But let me be even more clear. It's not up to an employer to decide that either. The choice to join a union is up to the workers. Full stop. Full stop.
For more on this story, which so many in the tech world are watching, Bloomberg Spencer Soper. Spencer, what is the latest? Are Amazon workers going to unionize or not?
That's a great question, and it's looking like it could be a nail biter that we don't get results on for quite some time. What's going to happen is they'll start tallying the votes next week. The voting has actually been underway by mail for a few weeks now. And so then the first process is the union and Amazon are going to look at the ballots that have been submitted and figure out any that they want to challenge. And then they set those aside. And then they tally up the ballots that haven't been challenged. And then they determine, okay, you know, what's the tally based on this? And will these challenge ballots that we've set aside even make a difference? And then they worry about whether they need to bring in those challenge ballots and litigate whether those ballots should be included or not. So it could really drag out. Or if we have a decisive victory one way or another, we could get some pretty quick results.
Meantime, you have Senator Bernie Sanders speaking in Alabama, and ahead of that, you had an Amazon executive kind of provoking him, Dave Clark, who runs Amazon Logistics, tweeting, "Paying workers $15 an hour doesn't make you a progressive workplace." Excuse me, that's the prior tweet. Hang on. "I welcome Senator Sanders to Birmingham and appreciate his push for a progressive workplace. I often say we're the Bernie Sanders of employers, but that's not quite right because we actually deliver a progressive workplace." We're going to talk about the follow-up in a second. But why do you think Dave Clark sent that tweet?
Well, he knew that Bernie Sanders was coming down and drawing attention to this issue. So he's kind of preempting the visit, you know, saying that he welcomes them. Dave Clark has kind of emerged as this rising star. And out of all of them, he's probably got the best Twitter game. He's a little less robotic, comes off as a little more authentic on Twitter. But I don't know if this is the fight they want to pick, because they're really getting dunked on hard on Twitter now about a lot of other things and just drawing a lot of attention to it. The challenge here, though, is like Bernie for years was, you know, criticizing Amazon about working conditions, about the fact that they had a lot of employees who got government benefits for things like food assistance and medical care. And Amazon's 15-hour wage pledge almost seemed like kind of a shut up Bernie move, you know, like, here, we'll just pay everybody 15. And at the time, it wasn't even so much as a raise as it was like moving the pay, changing the pay around, pulling back some stock benefits and performance benefits and just paying a steady wage of 15 an hour. And so there's just been this constant battle between them about that. And Amazon really wants to be compared to like Walmart and fast food jobs, in which case they look very favorable with $15 an hour wages and benefits when you start, and not be compared to like a union delivery driver, like a UPS driver or a union warehouse driver. Those folks may earn as much as, you know, twice as much as them.
So let's talk a little bit about the follow-up quickly, Spencer. You get a Democratic representative, Mark Pocan, responding to Dave Clark saying paying workers $15 an hour doesn't make you a progressive workplace when you union bust. and make workers urinate in water bottles. Then you have Amazon itself responding to that in a tweet saying, "You don't really believe the peeing in bottles thing, do you? If that were true, nobody would work for us. The truth is we have over 1 million incredible employees around the world who are proud of what they do." First of all, do Amazon workers really pee in bottles? And what is your take on this?
Yeah, that's been shown, and it's especially on the delivery side, and especially during the pandemic, it became a real challenge to be out on the road, and then there's just nowhere to go to the bathroom. So I think that's a challenge that transcended Amazon. But then there was a criticism that these people are under these rates, these constant rate pressure, that they would have to find ways to pee that save time, like using a bottle. And I was kind of surprised to see Amazon's response, because it was like they were arguing about whether their workers pee in bottles, but meanwhile there's a video from 2017 of an Amazon delivery driver actually defecating in someone's driveway that was caught on like a security camera.
Okay.
So I was surprised that they were like inviting this fight on themselves. They might want to be a little bit more deliberate about the facts and the narratives that they want to challenge.
All right, Bloomberg Spencer Soper, thanks so much. We'll continue to follow and you'll keep us up to date. Over to the markets, New York Stock Exchange seeing a new addition, the secondhand online consignment company thredup. The company's shares sold for $14 in the IPO, opening $18.25 a piece, closing at $20 Friday, giving the company a market value of $1.8 billion. I spoke to CEO James Reinhart earlier this afternoon.
We feel very good about how we opened today, and we have a great shareholder base, and so it's a bit surreal, but feels really great. Testament to all the hard work.
There are a few other companies that have gone public in the secondhand retail market recently. Poshmark, My Teresa, The Real, a couple of years ago. What sets you apart from the competition, and what's your outlook for post-IPO growth?
Yeah, I think there's probably two dimensions that make us really different. I think the first is that we're really focused on the mass price point. So, we sell, our average selling price is $17, $18. And so, we focus on a market that we estimate 6 times larger than the luxury market, the mass retail market. And the other thing is that our business is a managed marketplace, meaning that we do all the work, for our buyers and for our sellers, versus another business that might, connect buyers and sellers like Poshmark or eBay. And so we feel like by doing all of the work, for the seller and for the buyer, that we can ultimately create a much bigger opportunity. And I think we think the category is large, and we think we're well positioned to take share in that category over time.
Curious how the pandemic has impacted demand for secondhand clothing and how you expect demand to evolve as we come out of the pandemic.
Yeah, 2020 was a challenging year, but I think our business, we grew 14% year over year, in an apparel market that was down double digits. So I think that the
thredup CEO James Reinhart there. You can catch that full interview at Bloomberg.com. All right, coming up, the Boys Club of Silicon Valley. A new Axios study finds the percentage of female decision makers at U.S. venture capital firms continues to climb, but slowly. When it comes to female entrepreneurs, however, the environment getting even worse. Longtime investor Jenny Lefcourt, general partner at Freestyle VC, joins us to discuss her efforts in uplifting women across the tech industry. This is Bloomberg. Crunchbase has found that U.S. startups raised a record $143 billion in 2020, up 12% year over year. But funding to venture-backed firms founded by women dropped 22%. Female founders raised only $3.2 billion in 2020, down from $4.2 billion in 2019. Joining us now to discuss the need to improve support for women-led startups is Jenny Lefcourt, general partner at Freestyle VC. She also sits on the board of AllRaise with Aileen Lee and Jess Lee as well. Jenny, thank you so much for joining us. Wonderful to have you on the show. So there's a huge concern about women backsliding in the pandemic. And if you look at some of these numbers, especially when it comes to women entrepreneurs, it looks like you're seeing that. What is happening and why?
Yeah, so it's hard for me to tell you exactly what is happening and why. I mean, without question, the pandemic has hit women heartily because all the duties in the home have gotten harder. But we're also seeing so much. So I'm an optimist, and we're seeing so much good that is happening that I honestly believe that the numbers will look so much better in just a few years. And there are things that are happening now that don't show up in the numbers.
So where do you think the numbers are improving, and where are your biggest concerns?
Yeah, so I think where we're seeing the biggest improvement is in the number of women and people of color joining firms on the venture capital side. So here's what's happening. Founders now know coming out of the gate that diversity matters, and they want diversity within their organization. And they know that then getting investors, having a diverse cap table, helps them do that. So founders are coming out of the gate looking to have a diverse cap table and looking for firms who are diverse. And so you're seeing more women joining firms than you ever have. And so I'm talking about the leading firms, Andreessen Horowitz, Benchmark, USV, Sequoia. And so I think that while the numbers are not good and you have 70% of firms still that are not diverse, I think that as you see the leaders looking into the future, knowing that's what you have to do to stay competitive, I think you're going to see a lot more follow suit. And then I think the more diverse the funders are, the more diverse the founders will be.
So let's talk about your portfolio as we come out of a pandemic. The world is changing once again. Yeah. Where are you doubling down and where are you pulling back? Like, what trends aren't here to stay?
Yeah, so I would say, I don't know what you've heard from other VCs, but this has been a crazy time. And when the pandemic first hit, I think everyone was pulling back and getting ready for winter. And the opposite has happened, and that you've seen a lot of sort of roadmaps or markets accelerate. So, for example, Daily, which just announced their Series A, that was the last investment I did before the pandemic. And what Daily is, it's an API, it's an audio and video API that enables platforms to have audio and video natively within their app. And so while I was bullish on that space before the pandemic, post-pandemic, the surge of demand was just for Daily and what they do was just staggering. So quickly after the pandemic hit, they raised a very competitive Series A. And then companies like BetterUp, which I know you're aware of, that just announced their Series D at $1.7 billion. What they saw in the pandemic time is a greater demand because employers realize they really have to support their employees in such a hard time. So I think you've seen a lot of acceleration in future of work, in mental health, and in education. And I think we're just going to see more of it.
Let's talk about BetterUp because they made a splash this week. Prince Harry joining as Chief Impact Officer. This is a company that helps people work on their mental health. Why Prince Harry? How is this going to work? Tell us everything.
I wish I could tell you everything, but I'll tell you everything I know, which is that so far BetterUp had been focused on professional development, and they democratized coaching, right? Coaching was this thing left for the C-suite, or only the C-suite got it. And BetterUp, through science and technology and amazing coaches, was able to bring it to all employees. And they always wanted to sort of provide BetterUp care, which is the whole self, and bring preventative mental health into the roadmap. And so Prince Harry really does sort of increase the global conversation and community around preventative mental health.
You're also an angel investor in Discord, which made some news this week as well. Bloomberg reporting that Microsoft is interested in potentially buying Discord. Discord could still go public. Do you have a preference as an investor?
I really don't. I'm an angel investor, and it's been a wild ride. And I think that if Microsoft got Discord for $10 billion, it would actually be a amazing steal by Microsoft. However, as an angel investor who came in, I was in the incubator, so I've been there from the beginning of time. It's been an amazing journey. And so I don't think anyone would be upset if it sold at $10 billion, but I also think there's a lot more headroom.
All right. Well, we'll be watching. Jenny Lefcourt, Freestyle VC General Partner, thank you so much for joining us. Still ahead, Would you buy an MLB season suite ticket for $54,000 or the price of a single Bitcoin? Oakland A's president Dave Kovacs joins us next. They're the first team to sell tickets in exchange for crypto. And as we head to break, taking a look at some electric car companies losing charge. Tesla, NIO, and Plug Power all ending the day down. Of course, we know there's been concerns about supplies of chips for car making, a story we're continuing to follow as the chip shortage continues. This is Bloomberg. Bitcoin has regained some of its losses from earlier in the week, getting back up to $54,000. The cryptocurrency is also having a moment in sports. The Oakland Athletics have become the first MLB team to price its suite tickets in Bitcoin for the season starting April 1st. Joining us now for more, Oakland A's president Dave Kovacs. Dave, thank you so much for joining us. There are a few Oakland A's fans in this house, so I'll start there. So why did you decide to take Bitcoin and now?
You know, we've heard from our fans that they're interested in paying with crypto, and we'd heard it for about 6 or 8 months. And so we said, hey, let's see and take one of our products, our suites, put it on sale for 1 Bitcoin and see if we can get any takers.
So are there any takers? I know about a week ago you said there was one person who was getting close. Has anyone bought in Bitcoin yet?
You know, we have not had a transaction yet. We've had over 100 inbound inquiries, and, you know, we have till basically next Thursday to get people on board, and I'm hopeful that we get 2 or 3. There's 10 suites we've set aside for this. Hopefully we'll get 2 or 3 by opening day. So we're kind of right at that moment where hopefully it comes through.
What are the inquiries about? I mean, isn't it either a yes or a no?
You know, I think people are trying to learn more about the product and how it works and, you know, how they can use it. You know, there's social distancing in the stadium and things like that. But we're hopeful that we get, you know, a couple people to transact. And for us, you know, we're trying to respond to our consumers and the marketplace and offer something unique and different in Oakland.
Will you accept other forms of crypto? I mean, what about Ethereum? What about Doge?
We're focused on just Bitcoin for now, but I think if it catches on and we get interest, we are open. We use BitPay in terms of our processing backend, and they can accept other forms of cryptocurrency. So we are very open to that.
And do you plan to continue to hold it in Bitcoin, or would you convert it to traditional currency?
No, we're going to hold it. We're going to hold it. You know, we're believers in it, and hopefully it continues to go up. And maybe we can sign some big free agents with some of the proceeds. Who knows?
So season starts April 1st. What are your thoughts going into a full season versus a very impacted season last year?
Well, we're so excited to have fans again. You know, last year we just had cardboard cutouts. So to have starting 20% capacity, about 11,000 at the Coliseum, it's going to be great to have the energy and excitement. And hopefully we can build on that and end up with a full stadium by halfway or partially through the year.
So speaking of the Coliseum, it's been turned into a vaccine site. How is that working out? How much longer will that be in operation?
Yeah, it was actually the first federal mass vaccination site in the United States, and we were proud to put that in place with the Biden administration and Governor Newsom. And we've vaccinated several 100,000 people there, which is great. Many teachers, folks in the local community. It's going to run at least through the 11th of April, which was the original mandate, and it may run slightly longer. But we can operate at the same time with the vaccination center with our games with the limited capacity.
Now, the A's have been one of the most innovative teams over time because you've had to be. Your budgets are lower, your salaries are lower, and I'm curious what other innovations you're thinking about going into the season. Obviously, you've got this Bitcoin idea, but what else can you do to differentiate and keep the thing that has made the A's so great?
Well, you know, actually, we like blockchain in general. And so the non-fungible tokens are something we're taking a look at, especially with our intellectual property and our players and plays. And being able to use that as a giveaway. And so I think there's some things like that we're looking to break some new ground in baseball and in sports. And that's really been a great area for us to try new things in Oakland, and it's worked very well for us.
And how about that new stadium? I know you're working on one near Jack London Square. Fans are a little skeptical since it hasn't happened yet. What can you say to give them confidence?
Well, we just had the environmental impact report released, which was something that was held up due to litigation. We beat back the naysayers who filed a lawsuit. So we've built some momentum, and this is really the key year to get a vote of the city council. Everyone else has approved the project. It's coming down to a city council vote, hopefully later this summer, and we're very hopeful that we'll get a positive and an affirmative vote to move forward with the project.
All right, Dave Koval, president of the Oakland A's. Good luck this season. Thanks so much for joining us. And a reminder to our Bay Area audience, Bloomberg 960 is your radio home for A's baseball all season long, starting April 1st. And that does it for this edition of Bloomberg Technology. Stay tuned. Wall Street Week with my colleague David Weston is coming up next. Joining him, former Treasury Secretary Larry Summers and emerging market investor Mark Mobius. Thank you all for joining us. Have a great weekend. This is Bloomberg.